Welcome back. You're watching The Money Show on ET Now. Let's now talk about, the announcement that the RBI did come out with, and that's the long-term repo operations and the forex swap. Now, a little complicated, for us lay people to understand, the ones who do not have their skin in the financial markets. But what you need to understand is that with this operation, essentially taking loans is going to get much more cheaper, and I'm talking more specifically on the shorter term loans. So is that going to be the case? I mean, the next time you go in for a personal finance loan, go on to one of the digital apps, will it be cheaper? So let's find out from Kunal Varma, co-founder and chief business officer of MoneyTap. Kunal, thanks so much for joining in. Is that going to be the case? If I log on to the MoneyTap app and request for a personal loan, am I going to be looking at lower interest rates because of the RBI operations, or is it too soon to say something like that?
I believe that the RBI's recent the LPR operation is definitely going to create the opportunity for us to overall see some reduction in interest rates. And the benefit will accrue to customers in some form over a period of time. Traditionally, banks and lenders, have not been able to transfer a lot of the benefits of the repo rates to customers. Over the past 12 months, the Reserve Bank has, squashed the repo rates by almost maybe close to 140 basis points. But very little of that has transferred as benefits to consumers. And primarily because most of the funds that lenders are raising are not at very cheap rates. The repo rate today stands at about 5.15%, right? And banks have not been able to borrow money at this rate beyond a very minuscule amount, like almost less than 1%, as per the liquidity adjustment facility and the marginal standing facilities that the regulator provides to banks. So what the RBI did is that, hey, look, consumers are probably not seeing so much of the benefits. And on one side, on the other side, the government encourages more consumption, more borrowing to be happening. So how do you really make sure that the effort is not only towards just reducing the repo rates one after the other, but how do you ensure that the benefits start getting passed on to the consumer? So this was the thesis behind it, and I think this is going to translate into the benefits passing to consumers. So over the next, probably a quarter or so, costs are rising on one side because of, we're going through uncertain times. Operational costs are rising, there are more uncertainty. But at the same time, this path that the regulator has taken will allow lenders to really cut down on their borrowing costs. So hopefully we should be able to start seeing, as a lender myself, I should be able to start, passing on some of these benefits. And moreover, just as a citizen, as a borrower, all of us should hopefully start seeing some benefits in the coming months.
Okay. So instead of the RBI cutting rates, you think that this was a more effective tool to ensure that, look, the customer tomorrow will actually get that benefit of lower interest rates, because the RBI itself will be pumping in more money at lower rates to lenders, to banks, basically. Okay, now the question is, what kind of loans could we see reducing? Because fixed rate loans, obviously, I don't think we'll see their needle move much. But are we looking at the repo linked loans? Are we looking at MCLR linked loans? Which ones would see the most amount of a decline in their EMI bills?
Sure. So the way the loans usually get structured is, if you see a lot of the lending rate, it gets anchored on the marginal cost. So the MCLR is the marginal cost linked lending rate, right? And a lot of the borrowing that happens eventually happens from the market as far as lenders are concerned. So banks and NBFCs, if they are raising commercial papers and their yields are comparable to, let's say, bonds in the market, the rates that they are able to offer are rates which are quite close to the marginal cost of funds or the market link rates. Now, and primarily loans were anchored to those rates in the past. When a borrower like you and I, let's say a regular citizen, who were to borrow money, they don't know whether the money is coming linked to, let's say, a particular repo rate or an MCLR or an SLR. What we believe will happen now is, let's look at loans in two formats. What we believe is that there are short-term loans and there are long-term loans. A lot of the long-term loans are also at floating rates, and the short-term loans tend to be slightly more on fixed rates. But the advantage that this LTRO operation will help is that for short-term loans, we can expect some of the rates, the repo rate related benefits to start translating into the rate cuts towards the short-term loans. Primarily because in the short-term loans, you're looking at, let's say, 3 months, 6 months, 12 months tenors. You're maybe looking at 18, 24 months tenors. And if you compare these with the loans that were available in the past, which are the longer-term loans, the rates were very, very different from the short-term loans. The short-term loans, the maximum benefit that a bank could get was between 1 to 28 days if they had any borrowing linked to repo rates. And they hardly do any lending for short-term loans, which are like 1 to 28 days. So if you think about it, the benefit earlier that the bank was getting from repo rate borrowing was only for 28 to 30-day loan, 1 month loan. And that is not a kind of loan that banks are giving. But now with the LTRO operations, banks can actually borrow money up to 3 years, 1 to 3 years. And that's beautiful because a lot of the personal loans in the market, short-term loans in the market can anchor their interest rates at these. So that's the benefit that we'll start seeing. So probably loans going up to 2 years to 2.5 years might start seeing some benefit.
Sure. Okay. All right. You know what? Actually, we're completely out of time, Kunal, but we got your point. This will essentially ensure that even the longer term loans taken by banks, it comes in at a lower interest rate. Earlier, repo is just for the more shorter term loans. So this will enable transmission of rates in a more better manner. Kunal, thanks so much for joining in. Lovely getting in your take. So folks, yes, you can buy in now at lower rates. We'll wrap it up on the Money Show. Thank you for watching.